Brian Manning here with your weekly update. So doing the update today because in observance of the holiday weekend for the 4th of July, financial markets and bond markets will close today at 2 p.m. and they will be closed tomorrow. So let's get right to it. Monday this week, still the saga in Greece, and no deal it looked like in the beginning of the week, and also the announcement of the stock markets and the financial markets being closed in Greece, and then Greece citizens only getting access to a certain amount of money, specifically 60 euros a day through an ATM, and because their banking system was shut down trying to avoid a really serious crisis. So certainly this makes international investors nervous and jittery, and Monday we saw a flight to quality, which meant we saw money move from financial markets, stock markets, specifically into bond markets. And when this happens, global international investors move into primarily three specific bond markets. That is the Japanese, the German, and the U.S. bond market. So Monday we saw a benefit from this, and mortgage rates went down a little bit. Tuesday, mortgage-backed securities gave up a little bit of their gains from Monday with talks of Greece again. Gosh, it'd be nice to get this behind us eventually, but saying that maybe Greece will stay in the euro even if they default on their debts. And again, still making the markets really jittery. Also got some good housing feedback on Tuesday this week as well. Case-Shiller Index, year over year, so May 2014 to May 2015, housing appreciation up 4.9%. To me, that's just a really great number on a national level. It's something that's sustainable and that we can keep up with on a month-over-month, year-over-year basis. So seeing something in the high fours on a national basis is really great. This was jobs week, and even though it's a short week, first week of every month we get jobs data on what happened in the prior months. Again, really important information that the Federal Reserve is looking at when making their decisions on when they should raise rates. So Wednesday of this week, first Wednesday of every month, we get the jobs report from ADP, the largest provider of private payrolls in the U.S. And ADP said that in the month of June, we had 237,000 new jobs. And analysts were expecting 220,000 new jobs. So not much movement in the markets. That's kind of in line with analysts' expectations. And then today, normally it would happen on the first Friday of every month, but since markets are closed tomorrow, we get it on Thursday. Today we got the jobs report from the BLS, which is the government's report. It's the Bureau of Labor Statistics. And the bond market is rallying on this. We're seeing a slight decrease of interest rates. And there's a couple reasons why. So BLS came out and said that in the month of June, 223,000 new jobs were created. And analyst expectations were for 230,000 new jobs. So, not a real big miss there. But a lot of other data that is of cause for changes in the markets right now and benefiting mortgage rates. One of them was that prior month revisions, so in the previous months, they had a downward revision, so a lesser amount of jobs created by 60,000 jobs. So that's a really big revision for prior months. Then we also had unemployment drop from 5.5% to 5.3%. And that's kind of a misleading number because unemployment is one of the items the Federal Reserve is looking at when trying to make decisions on raising interest rates. But the primary reason is because we had 430,000 plus people in the month of June leave the workforce, which is a very negative number. So that means that right now, in what's called the labor force participation number, we have 62.6% of individuals that can work are actually in the workforce working. So 430,000 plus people left the workforce last month and just are not even looking for jobs anymore. And this is really incredible because this is the worst number since 1977. And we're also seeing that hourly earnings were flat. So there was no increase, no decrease. Hourly earnings were just completely flat last month. So the reason why we're seeing a benefit in the bond market and why mortgage rates are benefiting from this is because this is potentially a little bit of an easing of inflation. And if we said in our other reports, inflation is the absolute enemy of interest rates. When the job market is mediocre, when you have such a large labor force participation that's leaving the job market, when hourly earnings are going flat, we're starting to see a little bit of an ease or cooling off in inflation. And when there's the ease or cooling off of inflation, that's going to help mortgage bonds and help mortgage rates. So we'll take that. We've had a pretty significant steady increase of rates from February 2nd through now, and it's good to get a little bit of a break here. I will be around all weekend. Hope everyone has a wonderful 4th of July. If you have any questions, have a buyer that needs to get pre-approved, please give me a call. You can reach me anytime throughout the weekend. Have a great day.